Hey everybody, it's Chris with Invest LYH, and every Thursday I do a office hours for my econ class. And what I'm doing tonight, I thought I'd go live and see if I can share some econ here. And I just wanted to check to see if there's anybody watching. So I can't tell if this is live or not. But anyway, I'm going to go into it and oh, there it is. All right. This is my second live. So I did one, I think a couple weeks ago, maybe a week ago. And I kind of just went through supply and demand. So let me go ahead. I'm going to share my screen here. I got to see. You guys are right on the forefront here because this is all new to me. So I'm sharing my screen. I think that I'm going to go with this guy here. All right, there we go. So if you guys are there, I'm going to pull up my phone to see if anybody has any questions because I can see the questions in the chat here. So we'll see if anybody has any. But I'm just going to go through and show you guys another economic principle that has to do with the market. And we're going to take a quick look here. This principle is going to be called the division of labor. Well, we call it economics, but in real estate, it's not so much the division of labor as much as it's the division of the market. What does that mean? So if we were to take a full market from, let's say, the lowest price point to the highest price point, the division of the market would start dividing this up. And how this is where economics pulls from statistics in a subject we call econometrics. Econometrics. Okay. And the first point that we would look at in a division of the market is the midpoint. This is why most of the time we look at the median home price because it's supposed to encapsulate all the low prices and all of the high prices. Now, the next point, as an economist, you would look at the midpoint, but then you would look at these things, basically what we call them the quartiles, but the general public would call them like they're each quarter, right? So the 25% mark and the 75% mark. And if you guys remember, a couple of weeks ago, I did a video on the Phoenix market where I looked at listings and pricing, and all I did was took the market and divided it up into 4 different quadrants. 1, 2, 3, 4. And I think what I found is that listings were growing here, and they were flat here, and they had a little bit of growth here. And the conclusion that I developed in that video is a conclusion that I introduced to an agent that I know out in Phoenix who did an excellent video afterwards. And what was happening is that we saw that the entry level, which is probably from here to here, was on fire. And because it was on fire, it was putting upward pressure on this section to move up. So if let's say in January, it was at 100K to 250K, because there was high demand, it pushed the market up to, let's say, 150K to 300. And what did this do on the overall prices? It shifted prices of the median homes up. Okay. So there's something to be explained within this market again. Because yes, in the middle is the median, and we have the quartiles. But there's also, I would say, 4 or 5 distinct markets within this market. And one of them is going to be entry-level homes. And I'm going to turn those blue. Entry-level is about 80 to probably about, maybe about 45%. This is entry-level. Down here is the investor side. It's hard to draw when I'm sitting in my chair. So that would be from 0 to about here. And there's some overlap, right, from these two. But eventually what will happen is, if a house is a pretty substantial investor or entry-level home, and it doesn't get taken care of very well, it's going to fall in a few years down to the investor market, because there's going to be a lot of deferred maintenance and things. So let's see here. Whoop. Now, let me see. I'm just kind of looking at my phone to see how this is working. The other markets are the move-up markets. Now, the move-up markets are going to be anywhere from post-entry level, so we'll call it move-up, and it will go all the way up probably to about here, and then from that last bit is going to be the luxury market. Now, the move-up market has significant areas too, because there's, I would say, move-up 1, move-up 2, move-up 3, and move-up 4. And what happens is, generally, a buyer will come in here. Hold on. Let's try this. Generally, a buyer will enter the entry-level market. They'll sell and they'll move up, let's say, 5 to 7 years. And they'll do it again. And they might even do it a third time. Now, at these 2 points here, they may skip the next move up and go right to luxury. And what happens is that generally means that they've had a significant impact in income. When people buy in the entry-level area, they could maybe be students, but then after a few years, they have some experience in their specific job, and then they can move up to a luxury home if possible. Now, one last step, and this is for older people. They are going to be, in general, around here, and they're going to move down. And what happens is they have, most of these people in general have a few kids, and the kids have grown, and now they're looking to downsize. Now, will that happen in 6% rate environments? I don't know. That is a question to be answered later on. Now, we have these markets, and one thing to understand is that each one of these markets, we're going to take the luxury market because I have some area over here to draw. Each one of these markets consists of what we learned last week. There's a supply curve and a demand curve. We have price on the left, quantity on the bottom, and zero in the corner. And so they have an equilibrium price, P1, for a quantity, Q1. Now, I talked earlier about the Phoenix market and how the listings were shooting up in the luxury section of the market. If you guys remember from last week, what that means is that demand was shifting outward, away from zero. And if demand shifts outward, what happens is that price, it was supply that shifted outward from zero still. So as supply shifts outward, the price has downward pressure, leading to price 2. Now, there's higher quantity, but the lower prices will prevail at that point. So if we have a market where the luxury market is at 10 million and the smallest home is at 100,000, and we have a median, let's say, of 4.5 million or 450,000. If we have a significant rise in supply on the top end here, and eventually this supply curve 2 leads to price drops, price 2, what does that do down here to the market? It's going to look like the market has a downward pressure on price. Okay. Now I think you can see why it's so critical to understand that the median and the quartiles are so important. Because if there's an increase in supply here, which puts downward pressure on price here, how does that affect the investor market? Right? Because what did I say earlier? I said each one of these, let's do blue, shaded areas includes a supply and a demand curve. And if supply here is steady, but demand is shifting outward, it's going to put upward pressure on that price 2, for a higher quantity. But if that is going up against higher supply on the luxury market, putting downward pressure on the price, which one will win? When we're looking at the overall market, the lower, higher price, meaning 5 million down to 4 million, or the higher, lower price, 150K up to 200K. It's going to take 10 of these homes to equal one price drop here. Oh, let's see. I got somebody here. Financial. Hello from Hawaii. Yes. Hello, financial firefighter. I know that I see you a lot in the comments, and I've been taken off of social media for the last month. I'm going to be a month off of social media other than YouTube. So it's probably why you haven't seen me on Twitter lately. But thanks for coming to my live. It's my second one, and I'm trying to just showcase some economics for people and give them a better understanding of the real estate market. So, but I think that's really all I wanted to go through today was just the division of the market. And how we look at it from a different perspective and how we can break it down. So I appreciate everybody. I'm going to stare in here. And let's see. Is it going to go back up? There we go. All right, everybody. Thanks so much. Thanks for coming in. What do I do here? There we go. All right. Thanks, guys. I'll see you next week. Thursdays, I'm going to start doing these. So they should only be 10 minutes long, but today it went a little long.